Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 30 minutes here on Options Guide TV. Today's date is Friday, April 19th. The markets are open and rocking and rolling, and we had Netflix kicking off earnings for the FANG stocks, for all the mega cap tech stocks, Meg 7, whatever you want to go with. Netflix, I guess, didn't make the Meg 7, but the stock has done really well. And we talked a lot about that on Wednesday, that it's really been the stalwart as far as the streaming wars are concerned. Everybody kept thinking that everybody was going to eat their lunch, and Netflix is the one company that has continued to do well in the streaming war. They are down today. They are down about 8% after their earnings announcement. And we did say the path of least resistance was probably to the downside. And we did a trade that was neutral to bearish and then could possibly be bullish if we would have got a move to the upside. So we looked at an alternative to a short call spread, and we did a skip strike butterfly. So notice I said an alternative to a short call spread, not an alternative to a butterfly. The concept is that you sell a short spread, bring in a decent amount of credit, especially around earnings, because volatility is high, quite a bit out of the money. Use the proceeds to actually buy a standard butterfly. So you're putting your hedge into your short spread is basically the concept. So you put it all on. If you just did the short spread outright, you would obviously bring in a little bit higher credit, but butterflies are cheap, especially when implied volatilities are high. So on the Netflix trade, the fact that the market went south, there's no concern at this point in time. You had 1 day for it to live. We talked a lot about the fact that if you're looking at Netflix or you're looking at any of these mega cap tech stocks, that it's much different to trade them on a Thursday earnings announcement where you have a Friday option contract that has 1 day to live, versus looking at a company that's announcing on a Monday, and then you have the entire week of trading. It's just a completely different dynamic as far as how the options are going to react after the earnings announcement. So with Netflix, you have a high price stock. Right now it's at $567. So that's going to pump up volatility. You have earnings, obviously, and that's going to pump up volatility. And Netflix is just Netflix. It's a volatile stock in general. So you have increased implied volatility because of the earnings. The fact that the underlying is fairly volatile just in general, high price stock, a lot's going to happen on that Friday. All that premium on these option contracts caused by everything that I just mentioned has to go away in 1 day. And that's part of the reason why I'd like to look at these companies that are announcing earnings. Amazon has always announced earnings on a Thursday. Sometimes you get Google that will join. Apple sometimes announces on Thursdays too, but Amazon is the one company, and especially when it was over $1,000, it was always very interesting underlying to trade after that earnings report because of the dynamics of the option pricing. Okay, so let's run to the TradeHawk software right away here. Right now, I'm actually in the paper trading portfolio. So I'm going to look at a few positions that are in this portfolio. Oh, and I also don't want to forget about it, but we did put on a skip strike butterfly at the beginning of the week. We'll probably do it again next week. But that's going to go out worthless. We said also our attitude on the SPX going into the week was the path of least resistance was to the downside. So we were going to do a neutral to bearish trade that has some protection in. So we did a skip strike butterfly also in the S&P 500 index, and that one's going to expire worthless on top of it. And that's a good thing with the butterflies. I'm okay with that. It's a lot easier to maintain a trade and not have to adjust them and get that small credit. Now, it's a small credit, but it would not be a small credit if you were able to do it, obviously, 4 weeks in a row or over a month's time. It would be obviously a very decent rate of return in your account, but it is a small net credit. So here in Netflix, we started, and I'm actually got a trade up that Wayne, one of our longtime listeners on Options Guy TV and just in general, had brought up at the end. We looked at a Netflix on the bear side of things. And when we looked at that, we were able to get this trade done for a smaller net credit, almost half of what the call side was. And we talked about why that was on Wednesday's show, but it was the call side was a 60-cent net credit, and the put side was about a 30-cent net credit. And they were both about one standard deviation away. So we were equidistant out of the money on the put side versus out of the money on the call side. And we received a lot less on the put side, and that's because of volatility skew. You can go back and review the tape if you'd like. But the market came down. It moved almost exactly the one standard deviation move after that earnings announcement. I shouldn't say one standard deviation, the expected move, what the marketplace was looking for the underlying to move after earnings. Once again, that's a line in the sand. That's an over under. If you want to think about the betting world of things, that's how you would perceive that. And it's a fairly accurate one in that you only have 1 day's worth of trading in the option contracts. So it's not like we're doing it on Monday and that expected move, which is the long straddle, the long at the money straddle, is representative of all the options, for every single day, Monday, Tuesday, Wednesday, Thursday, Friday. It's just one trading day. And it's hanging right around that, not quite to the one standard deviation move on the downside, just a hair shy of what the expected move was at. But here's the butterfly. Here it is. Here's the skip strike butterfly that we mentioned. And it said if you're doing it on the downside, which I'm not a big fan of because the credit wasn't that big, you can actually still sell this for a net credit to the account, because this is the trade that we set up. It's saying debit, but you would flip the script, right? You would do a sell, you would do a buy, and then you would do a sell. And then you're bringing in a net credit of 12 cents if you were unwinding this position. And unwinding is the correct vernacular to use when you're looking at a multiple leg option trade. So if I unwound this, we put it on for a 30-cent net credit in theory, if we did. And right now we could take it off for a 12-cent net credit. So now you're looking at about 42 cents on our $1,000 requirement for every 1x2x1 skip strike butterfly that we put on. Now, earlier in the day, this was trading higher. This was trading almost 25 or 25 to 30 cents, depending on when you were looking at the quote on the open. And let's run back and see how low it got. I got the chart of Netflix up. Low point was 556.80. Let's call it 557. And now we're at 569. So if we go back to our trading scenario, we got to almost 557. So we got down to this strike. Not like I said, it moved about the expected move. It didn't quite get to the one standard deviation move. And if you have questions about that, you can put them in the chat box. I'm going to talking kind of high level here right now, but if you have a specific question or you're a first timer coming to Options Guy TV, don't hesitate to ask. I'm willing to define things further if we need to. But so obviously this would have been trading for a higher net credit to the account. It's now at 15 cents. So interesting trade on the whole way that it all played out, even though our direction, we decided to do the call side of things, which means that with that butterfly, you are neutral to bearish and then eventually bullish at the end of the day. So let me go and explain that with a chart. Much easier to look at. Okay. So this was the put side of things. When we did the trade would have been 40 points higher, right? This is real. This is live, real time. But if the market goes up and you do it for a net credit, okay, all the options expire worthless and you make that net credit. No big deal. Market goes down, you're okay all the way until you're not, right? Which would be all the way up here. Basically, the strike that we skipped. So by looking at this would be the 530 strike. So right here, right where this is where that break even is at. That is where our risk kicks in. And this is basically the short spread that we would have looked at selling. So now that we're on the last date expiration, this actually has a timestamp on it. So I'm pointing to the timestamp on the date. So this is saying as of today. Now, by the end of the day, this has to go to there, right? Market is here. So this is going to explode to a potential 10-point a reward if you hit the sweet spot, which is our middle strike or 540. So this is the amount of time decay that has to happen. And that's what I'm talking about when I kicked off the show about the dynamics of a high price stock, a volatile stock, and add the volatility of the fact that they have earnings. And all of a sudden, poof, all of that time premium has to go away in one day. And that's what this profit and loss graph, or what is called in the Trade Hawk software, the what if graph, is showing you, is that by the end of the day, this has to explode. So if you do think the market can go back, and it got to right here, this is where it got to, it didn't quite get all the way down, then obviously anywhere between 550 and 540 would be a real nice area. Now, if I do a skip strike, and let's say we did do it on the bear side of things, which I'm just showing you this because we mentioned it at the very end of the show, and this trade would have worked out better. The other trade, not necessarily, not at this point, because we got the call side of things done for 60 cents to start with. So we made 60 cents. That's completely not even worth looking at. The strikes, and I'll just give you the strikes, but they're all basically trading for zero or zero bid by 5 cents. The strikes were, I didn't write it down. All right. I don't think that there it is. Okay, 1 second. Let me get the strikes. My eyes aren't what they used to be. Okay, so the strikes were 680, 690, and 710. I remember now we centered it right around that 700. That's where our risk kicked in because it's a nice big round number. It's hard for underlyings to break through those type of numbers. And that's just a simple little thing. So that's where we centered it, right around that 700 level. So we are now at 560, about somewhere in that range. So obviously all those option contracts expired worthless. We did it for a net credit of 60 cents to the account. So we made 60 cents on our trade. Very simple, very straightforward. If you have any questions, please put them in that chat box. If you are on the Tradier YouTube platform, you can ask questions. We're going to change that around a little bit. You're going to be able to ask questions no matter what platform that you're in. But at this point in time, that's the platform you need to be in. And I'll be happy to try to address any of them during the show. Okay. So the other trade that we did was the same type of trade. We did it in the S&P 500 index. And I'm not going to set up the trade either because we are way out of the money on those option contracts. It's been a rough week. I heard something that since the last time we had this much of a down week was October of 2022. So, yeah, meaning to say we have had a real rough week. And, it's probably a good thing that we're going to get into the heart of earnings season, at least as far as the tech stocks are concerned. Next week, we have, on Wednesday, we have Meta. Thursday, we have Alphabet. We have Microsoft. Inside our paper trading portfolio, we also have Caterpillar. We have Intel. They're all announcing earnings next week. So the bulk of the mega cap tech stocks are going to be announcing earnings, and a lot of them are announcing on a Thursday. So it will be an interesting show on Wednesday. We'll look at maybe setting up more than one trade. And I'm still in the camp that there needs to be a little bit more of a sell-off before we can get back to normal things in the marketplace. Getting into May and talked about the seasonality. They've always said sell in May and go away. And that just basically means you're going to, the doldrums of the summer month months, usually the market doesn't do as well as it does in the winter months. I just see seasonality. I'm not saying that it's going to happen this time around, but right now it's kind of proving to be the case. We've been very, very, very strong in the market. Haven't even had more. A healthy marketplace usually has about a 5% pullback after a big run up like we've had since November of last year, and we just haven't had that. And that's a healthy way for a market to go up, is to get little pullbacks. Every once in a while we've got a couple of 2% pullbacks, but we haven't really had any sustained pullbacks ever since November. And because of that, that makes us top heavy. That makes it a little bit more scary for more than a 5% pullback if things don't go right. And next week that may happen, depending on what we hear from a lot of the mega cap tech stocks. People are now not just buying just because somebody says AI. They're actually looking at the platform. Google has came around. That stock has done really well. Kind of hurt me a little bit in our paper trading portfolio, which I'm going to show you here in a little bit. But I have a big decision to make with Google as far as our paper trading is concerned. All right, so let's look at that. So let's go back, look at the portfolio of stocks. I can't look at the S&P 500 index, which I guess I need to tell you about that trade. How much did we get that trade done for? 1 second. Okay, so that was done for a net credit of 70 cents, and it was the 52.20, 52.30, and then we skipped the 40 and bought the 52.50 on the call side of things. So we actually hit 5,000 yesterday, so we're quite a ways away from it. So those options just expired worthless, and they would, well, at the end of the day, they'll expire worthless. Okay. So now we went into Amazon. We sold the 195 calls. Those are going to expire worthless today. We sold them at 73 cents. They're now trading at basically zero. But here's the Google trade. So I've really struggled with this one, and I don't like, if we have deep in the money call portfolio, and this portfolio is doing really well, since we've started it in November. So obviously it would have been hard to do bad, considering what the market has done. But in the Google, we sold the 160 call option on that position. And that call option, I've had to continue to roll again and again. So now Google is finally, or Alphabet, to say it differently, is now came off a little bit. So when we rolled the 160, it was at 160. So now it's at 155. So what I would like to do with this position is probably just buy it back. The calls are going to be inflated a little bit. We sold it for $7.55, and now it's trading at $5.42. So in other words, I don't want the cheese anymore. Just let me out of the trap. Or we let it ride going into the earnings. On any of these positions that you have short calls on, like for example on Amazon, they're going to be announcing, I think next week too. I couldn't confirm, but I think they're announcing on Thursday also. But if I just don't want to be assigned on them. I don't want to be assigned on this call, and hence that's the name that I gave it inside the playbook when I was writing the book, the fig leaf, and that you're kind of covered. You're covered as far as the brokerage firm is concerned. You have the right to buy it at 150. You have the obligation to sell it much higher at 197, not 195. But the different expirations adds a dynamic that makes the trade annoying if you get assigned on a short call option. So that's my concern here in this Google position is, do I want to buy this back? And the markets came off. It was at 160. It's down $5 from that. That translates to selling this option at 755. We got it done for a net credit, but we're going all the way out to 5/31. That's the expiration date. So now it's trading for $5.42, and I think I may just buy it back. I'm going to let it ride over the weekend, and I might buy this back. Alphabet's earning is on Thursday, and I may just do that before we get into earnings. I want to do it maybe on Monday on our show on Options Guide TV, because I don't want to get too close to the earnings, because I do anticipate usually implied volatility is going up. So we might get a increase in the price only because of implied volatility, not necessarily because of the movement of the underlying stock. And in NVIDIA, I'm going to actually do a deep dive into this position. We were up over 150,000 on our I think at one point in time we had 4 call options that were way deep in the money. We've rolled those out and we've rolled them up in strike. This position is now down 21%, but it would have been down a lot more if we would have stayed all the way back down at the 500 strike call options. And that's what we own, somewhere right around 500. So what I want to do is on one of our Education Mondays, where we usually have where the markets are closed and we do something educational, I'm going to go through the NVIDIA process and talk about the moves that we've made and how good they've been. Honestly, we went deep in the money, bought the call option, let it ride until we got to the fact that our delta was 1. We started with 80 delta. Took some money off the table going into an earnings report because we were up very large on the position. So we sold an option contract. And then we took the ones that we had and we rolled them up. We went up to a 80 delta again. We sold the deep in the money option contracts that had a 1 delta, rolled them up and out in time, and bought option contracts that had an 80 delta. Hence, reducing our risk and bringing some more capital into the account, and have less risk now, but a totally different option contract, and having more time for that option contract to live. Home Depot, this position's down just a smidge. IWM, this is the one that we were looking at the rate cuts, and IWM right now to me is just a Fed meter, because the Fed has came out and said they're going to have, well, the pundits at one point in time were talking about 6 or 7 potential rate cuts this year. The Fed was leaning towards definitely a rate cut in June. The Fed Watch tool on the CME predicted that there was about a 70% chance of a rate cut. That got cut down to 50. Now the probability is all the way down to about 20. And now there's even some speak that maybe some of the financials or banks, some of the CEOs are saying, well, I'm not even sure if there's going to be a rate cut. So they're all over the board. And every time they say that there's not going to be a rate cut, IWM goes down. Every time they say that there is going to be a rate cut, IWM goes up. So in this position, I don't mind selling a call option, and I'm going to wait for about a week in time, but this is the one position that we're really taking it on the chin on. And is a new position that we put on. It did well for a minute, and now it didn't. So I don't mind selling the call against it. Eli Lilly, we did extremely well on, and with the same scenario that we had with NVIDIA, we rolled it up and out, took some of the profits. And since we've done that, now that position is down about 21%, but it would be down a lot more since we did the roll. But the roll has protected us a little bit and took some of the capital off the table. Schwab had a good earnings report. That stock is doing well. Might sell a call on that one too when this is all said and done, once we get through these quarterly earnings and announcements. All right. So with that said, I do see we got questions. So there's Wayne's back again. Hey, Wayne. All right. We're getting to the end of the show. So let's address Wayne's question. Yeah. Tesla's announcing on Tuesday. Tesla's down about 40% year to date and has earnings next week. On Tuesday is when they have earnings. Any thoughts on the direction and doing a butterfly next week? Well, Tesla's announcing on Tuesday, and that's the one thing I don't like about the butterfly as much, in that you have Tuesday, Wednesday, Thursday, Friday before the option contracts would expire. So if I did a directional thing, I would probably just look at a minimal risk trade, like a long call spread or a long put spread, if I were going to just play the earnings directionally. Now, one thing about Tesla is, as far as direction, I haven't been a great caller of Tesla, and a lot of it is the Elon Musk factor. Elon Musk could come out at any time and send a tweet, and it could either tank the stock or the stock could take off. It's becoming more and more of a car company. And we also have Ford announcing the day after Tesla, which I think will be really interesting to see where Ford is with their EV. Some people were saying that, with Tesla's problems with their Cybertruck, that the best EV on the market out there is actually the Ford Lightning. Be interesting to see how the sales are going and see some of those comments around those two vehicles. They just had a recall in Tesla for the Cybertruck. Don't know exactly what it was, but I just heard that there was a recall. So I would be very nervous about a direction on that trade. I personally would not play it in my own account around the earnings because of everything that we just said. If you wanted to take an opportunity to try to bottom fish, I don't mind selling a put on Tesla to the downside if you're looking to buy 100 shares. So sell something with a lot of premium in it, and if it comes down, you have that potential to buy it. It's not a bad way to approach it, but then you're just bottom fishing in Tesla, thinking that the company will eventually come back. It's now being treated, in my mind, more as a car company than it is as a tech company with the batteries. They're actually looking at the sales, looking at what's happening with demand, the battle that they have with China, and China taking some of their marketplace, some of their customers away, and just a lot of stuff like that. So it's going to be a very interesting report. I will be listening to it. I do not own Tesla in my own account. I got burnt in Tesla way back when their debt was in junk bond status, and Elon Musk actually was going to get a margin call. I actually have a CNBC scenario where they were talking about Elon Musk potentially getting a margin call, and then they magically were profitable at their next earnings. So Elon Musk really makes things weird in the Tesla world. I have a lot of friends that own Tesla and that own it, and the vehicles are definitely a different vehicle, a different experience to be driving them, but I don't know where to go with that car company and their earnings report. So there you go, Wayne. Not a long answer, but not necessarily a succinct one. We'll look at it. We'll look at it Monday because they will announce on Tuesday, and then Ford is on Wednesday. All right. No more questions. Thank you for coming. A very interesting week here on Options Guy TV. The trades all worked out this week, so we didn't do much for the adjustments, but we'll be back on Monday. Probably look at another SPX trade like we've been doing. We'll stick to the same format, and we'll find there was a lot of fun opportunities to look at with all the major tech stocks announcing earnings. So thanks for coming. Click subscribe, ring the bell. If you are on the YouTube platform, get all the notifications for the next Option Guide TV, and we'll see you this Monday at 11 a.m. Eastern Time. Thanks for coming.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.